All right, good afternoon. Welcome back here to TraderMinute. Great to have you aboard. I want to take a look at a couple things here with you and talk about the broader market in general. Then, as I promised, we'll go take a look at some steel and copper and iron ore and coal and go break those down. But I want to show you this market, and let's just start with the S&P 500. Down about 1%. Not that big of a deal as far as percentage move. Okay, but what is happening and the way that it's happening is a little bit different than what we have seen on any of the recent pullbacks in the market. As far as going up and then having some sort of gap down with a lot of follow through. The market hasn't dealt with a lot of big downside gaps this year. Most of the downside action that has gapped down has actually been bought up very quickly. Very rarely have we had a downside where things flush. There were a couple days. There was a day in June, a day here in August, but most of these were bought back up pretty aggressively a day or two later. Okay. So today's market action, is it breaking the 7? Sure. Okay, absolutely breaking the 7 on the daily. If we look at the weekly, it's still in a strong bullish upward trend. Okay, and if you break things down further, you can find minor support areas. Okay, but the reality of the situation is buyers stepped in here this morning, and for one of the first times in a long time, the buyers that stepped in got their fingers chopped. They basically got sold into, and that's not been a theme of 2013. The theme of the 2013 is buy any pullback, you'll be okay. And so a little bit of a shift here today. One of the other things that is happening here today is we are seeing the small caps underperform significantly. Okay, so they're kind of having the similar type action. Okay, but we're not only seeing the S&P 500 pull back, but we're seeing all of the sectors pull back in the same way. This is kind of a broad-based sell. Look at the transportations. The transportations had a very nice bullish run going, bullish breakout, every reason to move higher. They're not. They broke down here today. They're down right along from a percentage basis with the small caps. Okay, and breaking below that 7 in a significant way. You could say, well, there's no catalyst. Well, today, first day of the trading year, volume coming back. People's first inclination is to sell. Is that overall bearish for the long-term trend? Probably not. But in the short term, is that troubling action as far as to go down and have some sort of pre-earnings correction? Yeah, I mean that definitely brings that on the table. And from a sectoral standpoint, energy, industrials, materials, okay, consumer staples, utilities, healthcare. Every single sector. Which one did I bring up? Consumer discretionary, which has held up the best here today. The retail consumer discretionary overall has been one of the best, but every single sector, the major 9 sectors, is breaking below the 7-day moving average. Okay, even the financials, which Bank of America is giving a strong lift to the financials today, but even the financials are breaking. Okay, and so when you look broad-based, it's okay. This isn't just one sector being taken out because of some sort of news or another sector having something going on. This is broad-based market sell kind of across the board. If we look at kind of the advancers versus the decliners, we're dealing with about 1,500 more decliners than advancers. For 2013, this has kind of been a downside level where, normally 2,000, 2,500 suggests bearish exhaustion, but around 1,500 to the downside especially through late 2013, has suggested some short-term bearish exhaustion. A lot of the midterm indicators, okay, like the bullish percent index, not even in danger of turning bearish. Okay, no danger there, no trouble there as far as turning bearish on them. You do have some of the individual sectors within the bullish percent indexes, that aren't as strong, and could break down a little bit sooner. But in general, most of them are holding up. Okay, most of them are holding up. A lot of individual stocks are looking like some of the indexes. There are definite exceptions, right? But SLB. Let me go to SLB here. This looks like the energy XLE, right? Chevron. XLE breaking below the 7, even Exxon, breaking below the 7 for the first time since, it really mounted its most recent charge. What does that do? I mean, what does it do? Well, it just increases the risk of further selling. Okay, I know 2013 was an anomaly. Things when they broke the sevens, they didn't really go down very much. But you go back to 2012, 2011, 2009, even 2008 and 7, even during some of the bullish times, the breaks of the 7 have been significant, especially when the whole market has done so. Okay, definitely kind of has been overall bearish. 2013 hasn't. So, how does that play? How does that go? Well, there's definite concern out there for the bulls. And as far as playing it, okay, you're caught in one of these positions like Schlumberger, okay? The way I'm kind of looking at this is to say, okay, you got to look at your overall risk and say, okay, Schlumberger is going to hit a low today. What is that low? Is it 88.61, or does it go set a new low into the close? Because really, with the market here, we could see a new low set into the close. Okay, but whatever that low is, we break that low tomorrow. Time to move out and move on. Are there some put trades setting up? Yeah, there are. Perhaps one of my favorite areas is in the utility group. The XLU. The utilities have underperformed the market significantly. They have this drag of this rising interest rate environment on them. They're not trading day to day, meaning interest rates go up or down that day, so utilities are going to kind of go the opposite direction. They're really kind of showing relative weakness as interest rates have kind of pushed up above 2.8, 2.9 here overall. Okay, so utilities, as far as those of you looking to set up any sort of bearish position here today, I think utilities is very interesting. I also think consumer staples group is very interesting. I question how much of a sell-off you'll get on the consumer staples. If you take something like Hershey, do you get a sell-off down to about 94, 95 that then gets bought up? That'd be my concern when it got down to the lower Bollinger Band. But for those looking for puts, those are a couple of the areas that I would look at. You can also take some of these high flyers like the FedExes of the world. These are going to be a lot more risky, but these are charts where in 2013 you see no downside follow through, but typically you will get at least enough follow through to the lower Bollinger Band. So for those of you who are bearish out there, some of those are kind of setting up there. PW, I'm not feeling real bearish about the market into 2014 overall. Most years I go into the market and I kind of say to myself, all right, am I feeling bullish, bearish? What do I expect to happen? And I've kind of outlined a whole bunch of different things. And as I spent a lot of time, yesterday and last weekend, kind of looking ahead to 2014, I don't think that there is I think it's a fluid situation. I think it's a very fluid situation. I think this market has has factors in it that we could see a 20 to 30 to even a 40% pullback this year. The over optimism, the some of the bubbleistic aspects of it. All that said, for that to happen, we need some sort of catalyst that the market has no idea of right now. Okay, the government debt situation, they've done a good job of sweeping most of that under the rug and moving on. The Fed, for as much flack as they take, they've done a good job with this whole taper in how they controlled the markets through this taper. Could one of those things go awry? Sure. But I think there would have to be something a little more out of left field. It's pretty troubling when you hear someone like Schiller talk about a new bubble in housing. Okay, but this is the thing. Everybody knew about subprime in 2004, and the markets continued to surge in '05, '06, and '07. And so while I think there are setups and factors that could take this market down significantly, I look at it as almost a catch-22, because those same factors that could create a meltdown in this market, okay, are the same factors that could lead to this market just surging higher. Just absolutely surging higher, especially if we start to see some accelerated earnings growth here in January. Okay, so while yes, worst case, yeah, yeah, Jazz, right, 40%. Did I really just say that? Yes, I think 40% here, back down to around 1100. You're getting back down into where QE all started. Granted, we need catalysts. The market that's a very fluid situation. I'm not betting on that. I think that risk is there, though. Is it a low risk? Yes. But I think on the same time, okay, at the same time, okay, we have, we have the other extreme in play, where all the liquidity in the market, all the extra money that has just been dumped into these markets over the last 2.5 years, if that kind of catches fire to where we get an increase in the velocity of money into 2014, because the banks are feeling better about themselves, and some of that velocity of money starts to pick up, I think we could see some inflation gauges tick up, but you're still in a place where the market is kind of the only kid on the street, as the Fed has made it, and where a continued rally and a continued push is probable. John and I were talking a little bit, and both of us kind of look, and it kind of feels like the market wants to, during this year, kind of push up into the 2000 area on the S&P. That's kind of what it feels like there. Okay, but again, I guess to me, what's different about this market, most every other year, at the beginning of the year, I felt like, I could look at the year and say, all right, market's probably going to do this if everything kind of stays pretty status quo overall. This market, with what's happened this year, I look at and I say, I think maybe the abnormality would be if the market's only up or down 10%. I think that we're in for much bigger swings this year, but I think that the upside potential outweighs the downside potential. Even though that risk is there, I think there's probably more risk to a melt-up type of market. Bond returns in the coming year. Yeah, I mean, the bond action overall, we're dealing with, like, if we just take a look at the 20-year, the 20 years here on the TLT. Yeah, you look at this pullback, and okay, I mean, the Fed has done basically what they wanted. They've been able to take the edge off of the last QE, off of QE infinity, been able to bring rates back down into normalcy. I mean, look at '05, '04, '06, '07, even into '08. Interest rates interest rates fell during these times, as the Fed kind of kept their easy money policies in play. And even if the Fed, we're not typical bull markets. We're talking about the Fed raising interest rates. We're talking about the Fed tightening the supply of money to control inflation. This is a completely different bull market where we're not talking about the Fed tightening. We're not talking about the Fed tightening money. We're not talking about them raising rates. We're talking about the Fed keeping rates at zero and maybe lightening up on some of their bond buying programs. I mean, the market's not in a position to take a big hit like it has been before. In 2008, when Lehman went under, the Fed had the tools of interest rates and to kind of go after and combat that shock to the economy. It doesn't have that now, and I think that's one of the big downside risks here. Big picture 2014, even into 2014. At the same time, if there isn't that shock, that same policy, those same actions are enough tinder to keep these markets just humming. Please don't forget how much the markets moved up in the 90s. The markets moved up significantly. Doubles weren't out of the question. And to see the S&P go to 2,000 from here is not a real big percentage type move at this point. Okay. Look, the opinions are all over. I mean, you go on to CNBC, Market Watch, Seeking Alpha. You go on to any of these places. It's very popular for people to start writing, their 2014 opinions and all those, and they vary. But they always vary. There's nothing new this year that I look at any other year. The only difference that I would say I see in what's being written in the general tone is that the downside arguments are really weak. And even a lot of the downside people are talking about it saying, man, these aren't really good. They're really weak arguments. They're arguments that need further catalyst. And most years, the downside arguments are actually legit. There's a wall of worry there. Okay, there's a real wall of worry to climb, and that helps the markets go up. This year, we're not going in with any real wall of worry, and that's kind of a nervy type of a thing. Okay. Richard, would it be worthwhile to buy some SPX puts on the January 15 at the 1200 strike? I don't think so. I don't think so. I think that's a lottery ticket. To me there's nothing different between that type of position and just going down to the gas station and getting your lottery ticket, playing your Powerball. That to me is very, very similar. Okay. Max. So anyway, long-term market or 2014 market. Look, from an investor standpoint, I think it's one that you have to stay long. You have to, IRAs, 401ks. You kind of have to stay long here. 2014 so far. From a trader standpoint, I don't see a great value in trying to say, well, the market's going to do this or that. I do think the market will return to a little bit more normalcy in its pullbacks, in its seasonalities, in some of its rotations between currencies and stocks and bonds and stocks and some of those typical relationships that kind of went out the window in 2013. I think we will see them return, and I think overall that will make for a better trading environment. Maybe not a better investing environment, but a better trading environment. So first day here this year, we're seeing the market pull back, broad-based sell-off. Can we rally into the close? Sure. Can you argue lighter volumes? Big boys haven't come back yet. Yep, you can. But at the same time, you have factors like gold bouncing. You have factors like the VIX rising. I mean, the VIX is up 4%. You can say, well, that's not very much for as much as the market's pulled back, and you're probably right in that. But overall, as the VIX continues to rise, that's not a great sign for the markets. A VIX gap down below 14 would make me feel a lot better about upside positions tomorrow. Let's go take a look here at steel. Well, before I do that, let's talk Boeing for the challenge. Look, Boeing here, pretty flat. The Boeing has not moved in 2 weeks, right? I mean, it's really it's moved, but it's not really going anywhere, right? It's gone up to 138, it's gone down to 135. It's just kind of sitting in this flat. The union vote is tomorrow. Okay, that is a catalyst for Boeing to move. I am going to hold Boeing over that. My plan originally for the Boeing trade was not to hold it over that. I've spent a lot of time digging and researching and learning about that and what the details and things are there. And the more and more I look at it, the more and more I think it's a positive catalyst no matter what the result is. It looks very much to me that it is simply an event to be had and then move on, whatever the result is. It's not going to have a major earnings impact for years and years to come. It's probably something that even the result from yesterday is something that could still be adjusted and turned and revoted. It may not end tomorrow, or excuse me, tomorrow's vote. It may not end the situation tomorrow. But Boeing is a stock that has real earnings growth overall, and I think this event getting out of the way is enough to give it an upside. Now, if the market tanks, if the market decides to sell, Boeing's not going to have a shot. It's going to go to 130 before it comes back. Okay, so there is some risk holding it there, but as I look at that risk and take that calculated risk, I do think it's much more of an upside catalyst than a downside catalyst. Max, when will the news come out during the market after the close? It's going to be fluid. It'll be a kind of a fluid situation with that news, and as it comes across the wires, I'll post it out there and show it there. So that's Boeing. A couple others that I know some of you are in. Well, let's go Qualcomm, which we have for the Vibe Trend Rider. I got an email just recently asking if should buy into Qualcomm here since it's bounced a little. Look, Qualcomm and almost every other stock out there right now. I've not been able to step in here today and say, well, I want to buy or I want to sell, or the randomness has been heavier than what we've seen, kind of across the board. It needs a little settle out here. I do think Qualcomm, you can be a buyer above 73 and 73, 75. 74 would be a little more confirming, but Qualcomm has this support 73.25, 73.50. That's what we're going to play off of. There. Bank of America. I know several of you are in this. Please, this is not worth looking to take profits on here. Bank of America. If you've never traded Bank of America before, please. Bank of America can just defy gravity. We don't have to look too far. Just look at this run right here. Market was up, market was down through this time. Bank of America went up almost every day. And this is just kind of the start, just the launch. You're talking about $19 price targets on it. And, even from a technical standpoint, this breakout, we're at least looking at a $17 price target here for Bank of America. Can't argue you trim in some profit on Bank of America, but notice every time the market ticks down today, it's not Bank of America going down, and every time the market ticks up today, it's Bank of America going up. So even intraday, it's had some very good activity here. U.S. Steel. Which has done a little bit different of Bank of America. It went up real nice. It started to kind of weaken recently as some of the steel stocks have weakened. I've looked all day to try to find a real nice entry point. I can't find an entry point on them right now today. So likelihood of me getting into one of those today is very small. Now, I'll talk big picture of these steels in a little bit. Tesoro, the other refiners, there's nothing there. There's nothing to react to. Do you have a spinning doji? Sure. Is that bullish or bearish? Well, sure. You're right in the middle of consolidation. It's not like we've had a big uptick and now we have a spinning doji that shows indecision. No, the spinning doji just confirms the indecision that's been throughout this consolidation. Valero's pulled back a little bit, but relative to the outperformance it had the other day, very little. Western refining is held up pretty well with that same type of spinning doji. It's still in a very bullish position there. The Chinese internet stocks, the Baidus of the world, the Qihus of the world. Okay, look, there's no change in these. We talked earlier this week. They're in bullish modes. They had every reason to break down. Today isn't anything that's changing. Sina or Sohu. If you're looking to get into this space, the relative calm or quietness in this space today is an opportunity to be a buyer, in my opinion, and not a seller. And this is a group that can go up even if the market goes down. If you've never traded this group, they can be highly volatile. They can be very uncorrelated with the markets, meaning they can go up big, markets down. They can go down big with markets up. It's really just playing those individual charts, okay, on those stocks there. Okay, and then Schlumberger. Okay, Schlumberger down about $1.28 here. This one's been wild today as far as the way it shot down, shot back up, almost went green. Very similar to Halliburton. The rest of the sector's kind of done the same thing. This is one where I'm probably going to hold it into the close. I probably will not get out of Schlumberger here below 89. If it starts to weaken in the morning, I'll pop on out and move on. Okay, the options that for those of you who were on Tuesday afternoon, the options I got into weren't the incredibly risky ones. Remember, we were looking at a few of them. We got into the more conservative, so I'm not real worried about that delta too much in regards to Schlumberger. So those are just a few of the stocks and a few of the things happening. Let's go take a look at kind of the big picture: copper, steel, coal. And I want you to keep in mind that these are not gold, okay? And a lot of times people will think, well, copper and steel, they're going to move the same direction as gold and silver. That's not always the case. Gold and silver trade a little bit differently. The copper, the steel, the coal, iron ore, they're more industrial. I guess you can make a few industrial arguments for silver, but silver and gold have more of a currency effect to them than an industrial effect. Okay? So let's come in here, and I want to bring up the SLX. Okay, the SLX is an ETF for the steel sector. Okay, and let me show you what its components are here. And all I'm doing is going into a Google search and typing in SLX components. Okay, that's one of the easiest ways to find it, and apparently SLX is a bike too. So let me put in SLX ETF components. Here we go. And we'll just pull it up here from Yahoo. Here are the top companies. Okay, Rio Tinto, Vale. Okay, MT, POSCO. Notice how none of these are U.S. steel makers. None of them are here in the U.S. We have to get down to Nucor to get there, and then down to Steel Dynamics. Where's U.S. Steel on this list? Okay, they're not in the top 10 holdings. Okay, this is, I think, a very key thing to understand about steel. The activity going on in the steel world is in the U.S. markets. And those that are exposed in the U.S. markets, the underperformers have been those that have the more global reach. Okay, a few exceptions, but here you have Tenaris, here big steel maker. They're not doing anything what U.S. Steel is doing, right? I mean, they just complete divergence of trend. So I'm not a big fan of trading the SLX here. Okay, and having the weight of all of those international, the Vales and the Tenaris and the Metals on there. Okay, I'd rather stay in more of the U.S. focused steel markets. Let me show you my favorite three here. STLD, okay, Steel Dynamics, and I'm going to bring this up on a monthly aspect. Okay? And I do this to show you a couple things. Market rotation historically in a bull market, you tend to have financials lead the way at the beginning. And then kind of midway, you get some of the industrials and the energies leading the way. And at the end of a cyclical bull market, materials tend to lead the way. They tend to be the strong outperformers. Well, the last end of a material bull market that we had was back here in 07, 08. And the S&P 500, it hit its top in October of 2007. Look at all the appreciation in the steel group, or in specifically here in STLD, even though the market itself was going down. It really took Lehman Brothers to kind of snap that and to finally take that bull market off. Okay. STLD had been running before that, but its real outperformance of the market came there in 2008. We see similar things with U.S. Steel. I mean, U.S. Steel went from 100 up to 180. Okay, 100 up to 180. There were some around that were talking about U.S. Steel going to 300. Nucor, okay, during this 2008 period, look at the rise there. Okay, so whether you're bullish or bearish on the broader S&P, okay, don't try to correlate steel or the material stocks with your vision on the S&P 500. Okay, let them be apart. Okay, let them be apart. Notice how something like Nucor has not gone and retested its highs again. Neither is U.S. Steel. I mean, look. I mean, U.S. Steel is up at 180, and now it looks expensive at 30. Okay, STLD. Okay, very similar to Nucor, but these haven't tested their highs. Why? They haven't had the earnings growth. They haven't had the earnings power really come back to them. Okay, but from a technical standpoint, they are starting to show uptrends that have been lasting to where the sell-offs, before, we had this rebound in these steel stocks in '09, and then the sell-offs on steel were just tremendous. Every time the markets would sell off, steel would underperform. It would just get axed. And recently, that's not been the case. The steel stocks have kind of really decided to hold on. From an earnings standpoint, let's take a look at these a little bit fundamentally. Let's start with U.S. Steel, who got the upgrade today, $37 price target put on them. But in general, a lot of these stocks are going from negative earnings to a position where in 2014 they're actually expected to have positive earnings. That tends to be one of the most bullish periods for a stock, is when they go from negative earnings to positive earnings. Okay, it's one thing to go from great earnings and then drop on your earnings, but to go from negative to positive earnings tends to be a fantastic catalyst for a stock. And a lot of these stocks are kind of in this position. Nucor, not as much. Nucor's actually been much better run overall during the last 10 years. But U.S. Steel and some of these other steel companies, the STLD, which kind of turned positive on their earnings a little bit more recently, the earnings power is starting to come back into this group as a whole. Okay, is it some of the strongest earnings out there? No, but some of that earnings power is starting to come back. The other thing that's starting to happen in this group is the short float, or the number of shares being shorted, is dropping. The amount of the shorts, and you can say, well, the stock's been going up, so the shorts are gonna stay away. They're gonna get out. Well, no, the shorts have really, or they're gonna be getting out. That's why it's going up, but they're not getting back in. Okay, they're not really getting back in up at these elevated levels. We could see that change. But as far as for a thesis for 2014, as far as a group to significantly outperform, the steel group, with some of the earnings power coming back, some of their material costs going down, and some of the shorts kind of being away from them and potentially turning into longs, these steel stocks may just be starting to heat up as far as where to be able to get into them. Now, do you buy them today? Look, short term, I don't see a great buy here right here today. I've tried. I'd stay away from them right here today. But overall, throughout 2014, a very interesting sector. Now, generally, coal moves with steel. Okay, here's the coal ETF, KOL. Compare that to the steel ETF, SLX. What do you notice? Well, the steel ETF has outperformed significantly. Okay, it's outperformed significantly. This coal, it's been a sector that has just had a major downward trend. It did have a bigger bounce than steel in '09 and 2010, but since just has not been able to gain any traction. Some of the companies have gone out of business. A lot of this is because of China, with China doing a little bit of switching out of coal, because for especially in '06, '07, '08, a lot of Chinese power was a coal derivative there. And then some people also argue that some of the weakness in coal is directly related to the Obama administration here in the U.S. I don't know if there's any real facts behind that speculation, but for whatever those reasons might be. But coal here generally will follow steel, and we've seen steel in an upward direction for a good 6 months now. Okay, coal hasn't bounced nearly as much, but when we start to look at some of its components, okay, in fact, you can see coal is just getting back to its 200-day moving average. But if we start to break it down, BTU, a big player in the coal space, okay, finally has broken above its 200-day moving average, came back and tested it, found some support off of it, seeing some buyers come in off of that. Okay, we're starting to see some signs of life coming into coal, to where to see something like BTU trade up back up into the 30s sometime during 2014 would not be a big stretch overall. John, my brother who's on from time to time here on chat, this is one of his favorites, CNX, Console Energy. I don't think it's a great buy right here from a short-term option standpoint, but it's also one that's captured its 200-day moving average. You actually have a 200-day moving average that is turned up, that is starting to rise. Actually bringing the possibility of vibe signals into play. And in coal and steel for years, we haven't been talking about any sort of vibe bull type aspects. Console Energy, all the major moving averages tied up last month in November, I guess 2 months ago. Can it pull back here to the 37? Sure. But, keeping an eye out for some sort of entry to the upside here on Console Energy. Those are kind of two of my favorite coal plays that are out there, the CNX and the Walter. For those of you wondering what the KOL components are, let me pull those up for you. Kind of some of the other coal stocks that are kind of major. Notice CNX is number one on the KOL. Joy Global is in this index, and Joy Global is more like a Caterpillar in making the equipment. Okay, BTU. So BTU, CNX, they're really the two best ways to play with coal. Some of the other ways that we used to play with coal have basically gone under, or have been merged with other companies. Okay. But basically, Console and BTU. One other that I think's worth following from time to time, Walter. Okay, Walter is a really interesting company. They were one back in '07. They did coal mining and housing, and they sold their housing units. But you can kind of see Walter was one of those stocks that traded up in the triple digits for a while, and not even that long ago, 2011, up over 100, and now it's well under 20. You've had enough volumes come in. We start to see earnings growth. I'm very curious to see what Walter's next earnings look like. They're not expected to be positive yet. They've not been making any money. They've been losing. If they're able to kind of go and get some sort of positive earnings here in 2014. Look out. Walter is one that could easily double during the course of this year. So that group. Now, when you go into that group, you have also copper, and a lot of traders and analysts, it's popular to say that copper is the only material with a PhD in economics. Okay, meaning that the price of copper tends to follow the overall health of the economy. Well, that was true, till about 2007, and it really hasn't been since. If you look at a correlation, let's just come down here. I'm going to put in a simple correlation here. I'm going to go correlation between copper and the S&P 500. Okay, is what we have here. The SPX 20. Let me show that to you. Here's the correlation. And historically, it's been a positive correlation. Copper and the markets, copper goes up, stocks go up. Copper goes down, stocks go down. But notice here during 2013, that's completely gone out the window. There's no correlation between copper and the markets. It went negative, pretty strongly negatively correlated for a little while. And it's kind of been whipsawing back and forth, but really not a lot of correlation there. If you look and take this correlation even longer term on a monthly basis, where we go back and look, back here at 2001, during the bear market after 9/11, the correlation between copper and the market kind of faded. But bull market, strong correlation between copper and the market. We had the bull market here 2009 till 2000, late 2011. A strong correlation between copper and the markets. But what's happened? I mean, the correlation between copper and the markets has actually gone inverse. And to the point where you can almost say those arguing that copper are going to go up are actually saying the markets are going to go down. This correlation has switched. I made that comment earlier that I expect some normalcy to return to the markets this year where some of the old correlations come back. I think copper's one of those to where, rising copper would be strong for the markets essentially, as it's good for the economy, and falling copper would be negative. Okay, looking at the copper price, there is some nice support down here in the $3 area for copper overall. Perhaps one of the more popular ways to play copper has always been with the FCX, Freeport McMoran. Okay, now FCX isn't what it used to be. FCX used to be pretty much copper and gold, but they bought last year. They bought out an oil company, and that's one of the reasons why they pulled back so strong late 2012. They bought an oil company, and now they have oil exposure as well. But if we look at Freeport McMoran, one of the things that it's doing is it's breaking a long-term downtrend. Let me set this chart up just a little bit differently here. I'm going to do a weekly. Let's go 5 years. Clear out my moving averages. Okay. But here we have Freeport McMoran. Okay. And what it's been really since 2010, 2011. And all these stocks really rallied hard off the '09 lows. People remembered the prices they used to trade at in '08, and they kind of exaggerated to the upside. But since then, it's been on a pretty strong downward trend here. Well, one of the things that's happened with FCX is that downward trend is broken. And it's broken after kind of holding this 27 support area. And we're actually getting a little bit of positive divergence start to come into some of the momentum oscillators, the momentum indicators here for Freeport McMoran. So we have some building earnings growth, some positive catalyst. We have a sector that's generally performing well here. Freeport's one of those, I think, having on your bullish watch list through 2014 will be very, very nice. Now, let's say you don't want the oil exposure. There's a couple other ways to play copper here. One is with Southern Copper, SCCO. Okay, a Southern Copper here. Southern Copper above 30 would be really interesting. This thing broke 26, and it was like, oh man, it's going to free fall. From a technical standpoint, it had every reason to free fall below 26. It didn't. It created a pretty strong bear trap here. That bodes really well for SCCO here. And then you have TCK, Tech Resources. Some of you have been with me in past challenges, know this stock because I've traded it a few times. But this is one that's been in this downward trend. It did come and set a low late this year or late last year, and but it was a higher low for kind of one of the first times in a long time, in a few years, a higher low. See this thing go to a little bit of a higher high, especially on a good earnings report. I think that could bode very, very well for some of these stocks. So, you know, look, not that they're major buys today. The steel and the coal and the copper, and I didn't show you the iron ore, CLF here. CLF is going to be a little bit more volatile than the others, and I think it needs a little bit more earnings proof to say, okay, CLF's ready to go up. But this whole group, if we are talking about a late cycle bull market, okay, which is one of the common themes out there. If we are talking about a late cycle bull market, we're talking about a sector that stands for tremendous gains. And to me, the most interesting aspect of the upcoming earnings season will be these material stocks. And I have to admit, for a while now, I've not really paid as close of attention to them, just simply because their volatility has increased. The earnings have been pretty negative, but these have been really nice runs in '08. They were fantastic in '09 and 2010, and I see some signs of life kind of returning to them in that aspect here. So we'll obviously be keeping an eye and talking a lot about those as we go forward. Okay. All right. I'm quickly glancing at my email. A question came in about the agriculture stocks. Do I think the agriculture stocks will share with the material rally? No, I don't. I don't think there's anything saying they have to. I think the agricultures are kind of a world of their own. And, since some of the action in July, been tough to really get too much of a read on these ag stocks. They do have some cyclical components to them, some seasonal components to them that they've held up a little bit. But I don't think that they share the same thesis as the steel and the iron and the coal stocks. Okay. Look, of those groups, steel is my favorite, especially if, some of this stuff out of Congress, we start seeing them throw out these bills for, especially here in the U.S., for improved infrastructure and putting a lot of spending into infrastructure. The last time that Congress did that back in '09, that was a big boost here for the steel stocks. Okay. Alrighty. As far as market here, just a little bit. What are we? We're about an hour, 45 minutes into the close. One of the things that has not stopped, has not found a bottom here today at all, is oil. Oil has continued to flush, continued to drain lower on both the Brent and on the West Texas. I don't think there's any real reason to try to step in, be a hero, and call a bottom right here. You could argue a little bit of downside exhaustion here, but not something I would be touching. I would much rather go buy, if you want to step in and buy the bottom of oil, I'd rather buy Schlumberger than buy USO at this point. Okay. Boeing here, really kind of just marking time until tomorrow, right? Marking time overall. A little bit elevated volume today relative to what it has been, but nothing overly significant. It would be really nice. If we saw the market maybe push up 5-6 points into the close, and see Boeing lead that. That would be that would give me a lot more confidence. But that would be an ideal scenario. Okay. Yeah, AK, the drop in crude should benefit the refiners. Yeah, in general, the one thing that's happening with the drop in crude is the price of gas is dropping too, right? So, it's not just the price of crude, it's also the price of heating oil, the price of gas, all the distillates that come out of a barrel of crude oil there. Okay, but Tesoro here, it's what, down 1% overall. Valero down 1.5%. Western down 0.5%. There's no real change in the overall flow, of these stocks. Yeah, Pepsi. This action in the consumer staples is ugly. It's ugly. It's really we're dealing with stocks that didn't go set new highs, and so to see them go set new lows is definitely a possibility there. Uh, this is a technically significant move here for Pepsi. Now, notice the band's consolidating. Does that mean that Pepsi can't go back up? No, but chances are that Pepsi comes either down to this lower band and bounces and consolidates. But to be in Pepsi calls and think, oh, Pepsi's just going to go straight up from here, the odds of that happening are very, very slim. Are extremely slim. In fact, on these consumer staple stocks, I started drawing on them earlier today, and actually kind of putting in looking at targets to get short them. Today, with what's happening today, I don't know if it's the best of reads, but opportunities to be sellers of these on rallies, I think is probably where January is going to go. Okay. That's not necessarily a bearish thing for the market, though, either. I think that's just more of general expectation for interest rates. All right, so market here so far looking to set new lows. Okay, pushing down into new lows, exhausting. Well, I shouldn't say exhausting here. Let me pull off Apple here. Let's go to the ES, the S&P futures. We've kind of seen this. This is something very, very different from anything we really saw consistent in 2013, where little bounces they've been sold. Again, I'm very interested in the close today to see if the buyers are going to step in. But overall, this is weaker action than we've seen in a while. Okay, look, I know some of you are like, hey, this is buy. Let's buy because overall, these types of days you could buy in 2013. But this one's a little bit different here. This one's a little bit different. Yeah, Tom, do I think Bank of America's a buy here today? Well, you heard me say it's not worth pulling off here, right? It's not worth a sell. The risk here with Bank of America is, look, it's now how far away from the 7-day moving average? If we get a pullback to that 7, that could be painful for the option value increase that happened here today. But Bank of America has shown enough history to just go straight up, even in the face of negative markets. And I think this catalyst was good enough that it's going to provide a pre-earnings run up that I can't argue with buying it here. Is the risk reward ratio the best right here? The one thing with Bank of America I really couldn't put my finger on as I looked at it earlier was, man, if this thing starts to pull back, where's kind of the point of no return? Is it 16, 1590, 1580, 1570? I mean, really the only logical point of support here is about 1570, the gap today. And really pre-market after the upgrade, Bank of America traded around 1570 most of the pre-market. And so from a risk reward standpoint, it's a little bit difficult there. Okay. Yeah, AK IBM short. Yeah, one of the dogs of the Dow from last year had some of its run up. We see a little profit taking here with IBM. I do think, well, I do think there's a good chance IBM goes lower before higher, but when you bring it up even on an hourly basis, just keep in mind of where these Bollingers are, where they're kind of contracting at. You start to see, I even look at IBM similar to Schlumberger, right? IBM's going to set a low today. What is that low? Well, 185.25 so far. Can it close at a low? Sure. But if it breaks today's lows tomorrow morning, I think they become really, really nice shorts to kind of jump in there. And they become positions where, those who are long certain things can say, you know what, I need to back out and live to fight another day type thing. All right. Well, thanks for hopping on. Carl will be on here with you shortly with his top three, and then I'll be on with you into the close here today to kind of take a look at a couple more things. Please, any questions, let us know, and we'll talk to you later. Take care.